Famous brands, UK investment GBK, gourmet burger kitchen. Paul Theron may come up with a better sort of euphemism for that one. Great big falling knife, perhaps. It has been a disaster for famous brands. It's set to eat away at the company's half-year earnings. And now, under the UK's bankruptcy protection system, I've been taking stock with these and other movements with Vestact's Paul Theron and Rayhaan Joosub from Sentio Capital Management. Gourmet burger disaster, Paul Theron. What a shambles it's been. They bought it at 17 Rand to the pound, felt very smug about the level at which they'd bought it. They paid nearly 2 billion Rand and they've written off most of it.
Yeah, Great Britain, chainsaw massacre, that's what I'd be my recommendation. Unspeakable. You know, I don't know, I suppose in hindsight it looked like a good idea because in a different and expanding economy, but they did that deal after Brexit, which is interesting. Because you'd think that the Brexit decision would have made people realize perhaps there could be some consumer pressure here. Anyway, it's now on its knees, but at least what happens in privately run businesses, that these things, you know, they take the pain. They've taken the write-down. They're planning to put it into some kind of bankruptcy protection from its creditors, mostly the landlords from whom they rent premises. I mean, it's gotten to the point where basically they might as well write off the whole value and just revert. Shareholders have already basically, given it a complete heck.
British landlords are going to stop doing business with South African companies. I mean, Netcare is bailing on its lease obligations in the UK, and now we've got Gourmet Burger Kitchen, famous brands doing the same thing. Is there a redeeming feature in famous brands other than perhaps a Domino's pizza on a Friday? Not a Domino's, what's it called? I've forgotten their brand.
No, Debonair's is the Spur Group.
No, it's not. You see, they need to work on their local brands. Debonair's is a famous brand, believe it or not.
Beg your pardon. Debonair's.
As pictures of health are not big in pizzas.
One of the customers, that's why. So, I mean, effectively, it's very simple. There's a wart on a very good-looking girl. It needs to be cut off before we buy the stock. And the wart is all about UK. We completely agree. It was completely a disaster. It was a management team that looked at the South African macro environment, panicked, and made a mistake somewhere else. So effectively it was a double error.
Has anybody ever done a calculation? If one looks at the last 20 years of divestment from South Africa, a couple of firms have done really, really well and have expanded very successfully and continue to do so and will continue to do so. But the total value destruction of South African companies externalizing their businesses, I mean, you've just got to look at Steinhoff would be a good one to add in there. Old Mutual's multi-billion Rand Global Adventure would be another. So many companies, global aspirations, saying SAB Miller can do it, we can do it too, and get smacked out of the park.
You know, and the problem, of course, is businesses in tough global markets that are for sale are usually for sale for a reason. They either have weak shareholders or they're having some kind of problem, and what a wonderful outcome to have overstuffed South Africans coming in to buy the businesses from them. I don't know what to say. Although, it's understandable because many businesses get about as big as they can be locally, and so their shareholders want them to go further afield in search of opportunity.
And
you can add Woolworths to that, Truworths to that. You can say the hospital companies have done the same thing.
I mean, when you put Truworths in their camp, they seem to be having more luck than many other retailers.
The office acquisition seems an error in hindsight as well.
Okay.
Discovery and Aspen are businesses that are growing globally that appear still to have lots of upside. And of course, Naspers wouldn't be so big if it hadn't done that wonderful 10-cent acquisition.
And can we throw Bidcorp in the hat as well? Bidcorp's
some really good ones. I mean, I did ask Adrian Gore last week on the show. I said to him, is the 25% stake you got in Ping An Health your 10 cent? And you could see, I believe I could see that he wants to say yes, but he's far too cautious for that. But there are some great opportunities that sit in global markets for South African companies, but the billions that have been squandered. Nobody's ever done a sum.
It is staggering. Look, I mean, obviously as fundamental investors and Paul and do the same thing. I mean, we kind of do it on a stock-by-stock basis. If you agglomerate it, it's probably a staggering amount. And it's shocking. Guys need to stop doing this because effectively make an acquisition that's going to be value-adding to your business. Don't run away from something to something worse. Go to something positive and build something that's on a positive footing. Don't never run away. It's like leaving a job. I hate this job, I want to go. So you leave this job, but you go to something that's worse. Leave your current job if you're unhappy, but go to something that's better.
Yes.
So that's
Don't get out of the frying pan and into the fire. Laurie Dippenaar, a great quote from the former chief executive, former chairman, one of the co-founders of the First Rand Group, is whenever anybody came to them with a proposal to say, we think we should globalize, we think we should go and move a business into Australia, Australia or into the UK. Nobody ever wanted to go into the DRC or anything like that. And Laurie Dippenaar's first question always was, so which of the executives wants to go and live there? And that can often be the key motivating factor. And shareholders get taken along for the ride with big promises and get nailed, including this last month. Mediclinic. Now, Mediclinic, of course, has expanded and is a more valuable business today, I suspect, than it was before it went into Switzerland. But Switzerland is proving a bitter pill.
It is. It's tough because Switzerland is a great-looking market to invest in because it's lots of rich people, lots of old people, and there's compulsory medical insurance. But the Swiss government has been tinkering with the system, and in particular lowering the amount that insurers are allowed to actually pay for, or perhaps put differently, changing the rules that make it less likely for Swiss people to actually go to Mediclinics hospitals in order to pay for those procedures. They have to get private insurance to cover that. So that's been negative. But I honestly think the sell-off in Mediclinic has been totally overdone. And it's one of those cases I was alluding to earlier where there's been a dearth of buyers in the market. So some grumpy sellers, some short sellers getting on top of that one after its recent trading update. But to have that pull back from around 100 Rand a share or even 200 Rand a share where it was when it put its listing into London is absurd to come down to the kind of 60 Rand share price level. That is definitely a bargain waiting to be bought.
Okay, Mediclinic, a bargain waiting to be bought, yeah?
This is where long-term investing comes in. You need to have a very firm mind. You need to have a very strong mind to make money on the stock market. This is the time you buy stocks and companies like Mediclinic, because this is the entry point over a 5-year horizon where you'll make super returns on investment. Forget about the next 3, 6, 12 months. You'll never pick the bottom on the stock. You'll probably have some volatility. Stomach that volatility, and you'll make a lot of money in the long term with companies. Would you put
like Naspers into that with its 10 business?
Most definitely as well. This is the great entry point into the stock. What we spoke about earlier.
It could get better.
It could get better. You can't pick the bottom on the markets. It's again all about higher bond yields. Companies like Naspers effectively, and without getting too technical and bore the audience, a lot of the valuation of these stocks sits far into the future, and those companies are very sensitive to high interest rates. And as interest rates have gone up, those companies have come down. But that growth is still there. The Chinese market is very unique. The demographics of that market is very unique. You can't go in China, you can't go and get in your car and drive to a mall and buy something. You can't entertain yourself in a mall. You can't actually, there's gridlocks everywhere. So everything is done at home and everything's done online. It's a closed market. Tencent, Alibaba and JD.com effectively dominate those markets effectively. This is a great entry point into a very, very strong secular growth story. You've got an 18 PE with 25% compound earnings growth over the next 3 to 5 years. That's a sitting duck for us, we think.
You've got a friend, finally, Paul Theron, somebody who loves Naspers more than you.
Look, Tencent is a bit of a mystery to me because since the beginning of the year it's fallen by 40-something plus percent. My only conclusion I can come to is that Pony Ma must have forgotten to pay his Communist Party dues. Because he's the CEO of Tencent, and for some reason or another, the Chinese government, which is normally very helpful to their national champions, has decided to get all bureaucratic about approving their new online games and other systems. So it's not allowing them to actually make the money that has been associated with that company and its growth story. So it's very perplexing.
But it's not a problem. I mean, most of their game approvals took place in Q3 already. I think they got 6 games through, 4 of them already in the top 20. So I don't think it's a problem for them. Obviously, the risk is more for your independent game providers. They can't produce. And just take a step back. Why the government's trying to do this is effectively to try and reduce the addictive. Most of the kids are playing games in China. It's becoming addictive. It's becoming a social problem. So they're trying to get those very dangerous, violent, and sex connotation games out of the system. And it's not a dig at Tencent, it's the independent guys. So hopefully they get those guys out the system, and it actually makes Tencent a stronger business in China because the barriers to entry become stronger. So we actually think short-term pain, but we think longer-term.
Just another example of old men trying to tell young people how they should spend their time. It's unacceptable.
Oh dear. More on this conversation if you can stomach it after the break. Paul Theron this evening. Also with us, Rayhaan Joosub. We're talking all about financial markets. The month that has been a country that's had some very tough obstacles thrown in its way. Medium-term budget policy statement done and dusted. We're looking into the future in the next couple of minutes.